Good morning, and thank you for joining KBRA's Equipment ABS in Focus webinar. A reminder that this event is closed to press and media. Today's discussion will examine performance trends, ratings, and investor considerations. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Ratings and additional research, including our latest US equipment loan and lease ABS indices, can be accessed through the QR code on your screen. An overview of our upcoming structured finance event participation is available on kbra.com. Should you have any additional questions on the topics discussed today, we are always available for a follow-up call. Now, I'd like to hand things over to our moderator, Kenneth Martins, for introductions.
Great, thank you, Michelle. I'm Ken Martins, a Managing Director in KBRA's Commercial ABS Group. I'm excited to be moderating today's KBRA Equipment in Focus webinar. Joining me today are three of my colleagues who I'll let introduce themselves. Van, let's start with you. And Van, you're on mute.
Sorry about that. You'd think I'd learn by now. I'm Van Hesser, Chief Strategist at KBRA.
I'm Brian Ford. I head up securitized research at KBRA.
And I'm Joanne Desimon. I'm an MD in the KBRA Commercial ABS Group, where I cover various asset types, including equipment ABS.
Great. Thank you all. So let's jump right into it. Joanne, why don't you start us off, and if you can provide kind of a historical overview of the equipment ABS market?
Sure. So equipment ABS does have a very long history that dates back to the 1990s. And if we could advance to the next slide here, we do have a graph of US historical issuance volume over about the last 20 years. I will note in this graph that we've excluded from the data dealer floor plan issuance, as well as the recent equipment rental issuances, and also the consumer power sport type transactions that in some cases are labeled as equipment ABS. But what we can see from the trends here are that from basically 2012 through about 2020, we had a pretty consistent, stable base of issuance. And this was generated by a stable, long-standing base of repeat ABS equipment issuers that were basically issuing about once a year. This is not to say that there weren't some first-time issuers that entered the market during this period, but those new entrants were also offset by a trend of some exits, as there were some independent equipment issuers that were acquired by regional banks, and that caused them to exit ABS to fund their originations with their bank funding. And then following that period of fairly consistent annual issuance, we have seen over the past 3 to 4 years that there has been growth in issuance. This is generated, again, by a continued stable base of longstanding repeat issuers. The increases are driven by more frequent annual issuances. That's basically what drove a lot of the higher volumes in 2024, with repeat issuers doing 2 or even in some cases 3 transactions in a single year. Another impact that we have seen in the increase in issuance is on the large ticket side. There has been, over the last couple of years, some increase in large ticket issuance, as there have been a handful of first-time, more startup nature large ticket issuers entering the ABS market. And then we can see from the April data that this new year is off to a strong start for issuance.
Great, thank you. Brian, I want to turn it over to you. So can you share with us recently, and by recently, I kind of mean, since Liberation Day, how have volumes and pricing been?
Yeah, sure. Thanks, Ken. So certainly we got off to a really fast start to the year. During the first quarter, there was close to 9 billion of equipment ABS priced, which was 20 to 25% over the same, that same period in 2024. The last deal pre-Liberation Day to price was in mid-March. I think it was a CNH deal on March 14th. And then really the pipeline dried up as the market faced quite a bit of volatility. The pipeline's starting to build again. We saw a Dell deal price at the end of April, and M&T Bank, which is the legacy Leaf platform, just priced a deal earlier this week. Those deals priced wide of what we saw pre-Liberation Day. So just for some, just for a sense, look, if you look at the Dell deal compared to its pricing back in the fall of 2024, it priced 10 to 15 basis points wide at the last cash flow AAA, and all the way down to its Class D, which is a split rating of A triple B. It was about 40% or 40 basis points wider. The M&T deal priced 10 to 15 basis points, actually 15 to 30 basis points tighter though, versus its October deal. And that really is just at the AAA level. But comparing those two deals to a Great America Leasing deal, which is really the best comp, that priced in early March, we're still seeing about 25 basis points wider. And I think, what you're seeing in the broader ABS market is, that spreads are still wider versus pre-Liberation Day, versus when you look at the corporate markets in both high yield and IG, spreads have basically completely retraced. And that's typical of the ABS market. It's usually a week or two lag in catching up to the corporate. So I would expect over the next couple of weeks, really pricing to come back in line with the pre-tariff world we had.
Yeah,
Okay.
and I'll just add that, again, as a longstanding asset type, I think what we're starting to see is, once again, this longstanding asset type making it through just yet another stressor, having held up through many others, dating all the way back to the dot-com bubble, the GFC, and most recently COVID. So yeah, starting to see this longstanding asset type come through.
Great, thank you. So, both Joanne and Brian, both were making references to different types of equipment issuers, large ticket, small, medium ticket. So maybe Joanne, can you tell us what type of equipment ABS transactions are rated by KBRA, and does KBRA have a dedicated methodology for rating the equipment ABS?
Yeah, so KBRA's rated universe includes both large ticket transactions as well as small to medium ticket transactions, and also includes repeat issuers as well as first-time issuers. We do have a dedicated equipment ABS methodology, and under that methodology, we have an approach for the more concentrated large ticket type pools, and that's really a Monte Carlo style approach for reviewing losses. And then there's also an approach for the more granular small to medium ticket pools that's based on vintage historical loss performance. And then for the situations where you have pools where they are primarily granular, but they may have some higher individual obligor concentrations, the methodology also includes an adjustment approach to deal with pools that have those characteristics. And the other thing that the methodology does allow for is consideration of ratings for first-time issuers that may have more of a limited operating history. What we do for these types of issuers is that every first-time issuer, we go through an operational risk assessment. And we consider a host of different factors, and they allow us to come up with a view on what is the maximum rating that we can assign to the top tranche of a transaction serviced by a first-time issuer. And under our methodology and our operational risk assessment, one of the considerations is management experience. And we are able, in our analysis, to consider historical management experience in prior situations and bring that to bear to our analysis of kind of a new startup situation that may have less operating history. And this really is quite useful in rating first-time issuers because there are many examples in the sector of highly experienced management teams that may have worked together historically, for example, in the many lending arms of GE Capital that are brought together under a new umbrella with less operating history, but we are able to give credit to that management experience. And in addition, any data that can be brought to bear from that prior experience if it's relevant to the new situation.
Okay, great. Thank you. I want to kind of switch gears a little bit now and kind of talk about the economy and economy overall. So Van, I'd like to hear from you if you can provide us, your current view of the economic outlook, and also if you can discuss things like the long-term effects of protectionist trade on U.S. economic growth and the financial stability. That'd be very helpful.
Sure. So we'll set the stage. It's a lot to unpack there. I'll start with a quote from Larry Summers, former Treasury Secretary, who said with a bit of rhetorical excess, protectionism creates textile jobs at the expense of high-tech manufacturing jobs. So mull on that for a bit, if you will. Our current view, our baseline is the U.S. economy is slowing in 2025 to below potential speed. We consider potential at kind of the Fed's number, 1.8%, their longer-term growth estimate for the U.S. We think we'll get down to 1% in 2025, driven by two forces: normalization and policy uncertainty, right? So with regard to normalization, it took a while to drain excess savings from pandemic-era stimulus, but we're there. It's important to remember, because we've been growing at rates well above trend, and again, that trend being 1.8%, we've been growing at rates much above that for much of the past 4 years. The second force driving slowdown, of course, is the drag of uncertainty created by the new administration's policy leanings, we'll call it, most notably on redirecting global trade. Higher tariffs raise costs, including equipment costs, and discourage investment. Seeing that, we saw a spike, we saw a spike in equipment investment in Q1, which really was a pull forward to get ahead of tariffs. But make no mistake, we do expect this to lean on, as we mentioned, sort of investment and equipment purchases over the balance of the year. And safe to say that the tariff overhang has not gone away, right? In fact, it's only just showing up now in the hard data. Remember, upwards of half of imported goods in the US are intermediate goods, which are used in manufacturing. So we really look for the effects of tariffs to roll in over the next 3 to 6 months. So we're just getting started here. So knowing the administration is willing to negotiate, how much of tariffs are likely to stick? Well, it looks like you can count on a 10% universal tariff. The UK deal said as much. I think you can add on targeted tariffs on certain countries and industry sectors. All told, figured a 15% effective tariff rate. That's up from 3% at year end. And that's enough to take our 1.8% GDP down to our 2025 forecast of 1%. That's 1% with no recession, we would add. And that says a lot about the strong starting point on the part of consumers and businesses in the aggregate coming into the slowdown. We think that will keep growth positive over the course of 2025. Now, if you think about effects of slowing, or we think about effects of slowing really in the following way. At 2% or better growth, individuals, businesses, investors can't see recession. As a result, they borrow and spend, they expand their businesses through CapEx and M&A, and they invest across the risk spectrum. At 1% growth, you can see recession, right? So you become more conservative. You hunker down. Businesses or consumers will save rather than consume. They defer or cancel hiring. They postpone major investment decisions. They trade up in quality and simplicity, right? The risk is that this mindset shift hardens and it can become difficult to pull out of. Trade deals, of course, can reduce that overall tariff rate, but I would remind folks that it's easy to break things and difficult to build them back. And remember, the administration is counting on tariff revenue to pay for tax cuts. So again, we think that 15% or so tariff rate is likely to stick. Add in a complicating factor of renewed inflation pressure. And so when you add it all up, slower growth, higher inflation sounds a lot like stagflation. And that's kind of our base case over the near term.
All right, thank you, Grant. I guess also, can you also discuss supply chain impacts on the growth and stability?
Yeah, I think, and we thought a lot about this during COVID, and now we've got to think about it again. So redoing supply chains is messy and time consuming. It represents a drag on economic output because you're trading efficiency for security. Now, security presumably means greater stability, so there is that offset. But net, ideally, you want efficient security, and that's not likely to result. So we think, again, there's going to be a net loss of economic output as a result of all this. Now, to be clear, for much of the economy, services and domestically produced and sold goods, it's kind of business as usual. So we don't want to overstate the impact here of what the tariff regime represents. But it's those products that use cheaper imported intermediate goods, right? So think about chemicals, electrical equipment, plastics, information communication technologies, including semiconductors. Those are the kind of products that are, and add to that, products sold into global demand are going to be the ones that are facing higher costs as a result of tariffs.
Okay, thank you. So Joanne, we just heard what Van said about the impact of tariffs on supply chain for the economy overall. I guess if you can share with us specifically impact on equipment ABS.
Sure. So since equipment ABS does have a long history, we do have some historical experience with the impact of tariffs on the asset type that we can look to. But the first area of potential impact for tariffs on equipment ABS is increased volatility of potentially delinquencies and default frequencies based on individual impacts on different types of obligors. So, for example, a large percentage of the equipment that backs these transactions is agricultural equipment. So any tariff impacts on farmers could potentially lead to volatility in their performance. We have seen this occur historically when there have been other tariffs on specific crops. But the other thing that also occurred is that in most cases, the volatility was not that great because the federal government has historically stepped in to support farmers with subsidies and other types of support. In addition, another big percentage of the equipment backing these deals is construction equipment. And we've seen historically that one useful indicator of the performance of construction equipment contracts is housing starts. So any tariff impacts that would be detrimental to housing starts, such as, for example, lumber tariffs, could serve to increase volatility of delinquencies and losses for these construction company obligors. The one thing I will note, though, that's different from when we saw this type of stress historically back during the GFC is that in the current equipment ABS universe, we really don't have any pools that are solely concentrated just in construction equipment and therefore would be highly impacted by these effects. It's not to say that there aren't pools that have some higher concentrations of construction equipment, but there definitely is at least some level of diversification by equipment type across the individual pools in the universe right now. Another obligor type that, could potentially be impacted by these tariffs, are obligors that operate in trucking and transportation, as demand for these types of services could be impacted by declines in global trade. And of course, that would come on the heels of a couple of years here where these types of obligors have been experiencing stress already. When we look to large ticket obligors, they could be impacted if they're operating in industries that may be more impacted by tariffs, such as working with automakers. And then, of course, lending to equipment types like shipping vessels that, again, may be more impacted by declines in global trade. You could see some volatility there. And then lastly, on the small ticket side, the volatility impacts would be among small businesses that may be more exposed to and dependent on import prices. Now, in the opposite direction, offsetting these potential increased volatilities of delinquencies and default frequencies, we do have the potential for increased recovery rates generated by increased used equipment values. And we have seen this happen historically. What occurs is that if the prices for new equipment are much higher, then what we see is the users will be incentivized to purchase refurbished used equipment or to hold on to their equipment at the expiration of their lease terms. And all of this serves to increase the demand for US equipment, the prices of used equipment, and therefore increase recovery rates in the context of an ABS transaction. Now, the one impact that I will note that does offset this to some extent, and we've seen this historically, is that we do have to remember that many of the issuers of equipment ABS transactions are actually the captive finance companies of the OEMs. And the OEMs are going to be incentivized to continue sales of new equipment. And therefore, we have seen them support those sales through subvention and other types of rebates, et cetera. And so that may offset some of the rise in used equipment values. But that we have seen this happen historically, and it does offset some of the potentially increased default frequencies with higher recovery rates.
Okay, thank you. Van, I'd like to go back to you again for another question, I guess, related to the economy as well. Can you provide your outlook on the growth and stability given the current interest rate policy? You're on mute.
Getting there. Yeah, I think it's pretty clear that rates are still restrictive, right? We see evidence in interest-sensitive sectors such as housing. We see it in consumer loan underwriting standards, especially for less wealthy households. We see it in middle market corporate lending, where rates have gone 10% or more for many companies, right? The cost of money is limiting the expansion plans of many businesses, especially smaller businesses. So the Fed should cut rates, right? Well, ordinarily it would. That would be the plan prior to the new administration rolling out its policy framework. Much of that is inflationary, right? Tariffs, limitations on immigration and tax cuts, the pillars on which the new administration's economic plan rests are all inflationary. And that puts the Fed in a box, right? So we all know the Fed has a dual mandate to control inflation and promote growth. We also know that FOMC members really are judged based on their ability to control inflation. So we don't expect tax cuts until growth really is moving towards stall speed in our own models. That looks like the fourth quarter of this year, where we do expect a couple of cuts, but realistically, the Fed being in a box, rates being restrictive, this adds up to, again, another more headwinds for economic growth.
Okay, thank you. So Joanne, in equipment ABS, we've rated transactions that in both rising and falling interest rate environments. How have the equipment finance companies generally responded to the rising and falling interest rates?
Yeah, so basically what we've seen in equipment ABS is that, over the last period of rising interest rates, most equipment companies have successfully been able to pass along price increases to their customers. But this has occurred on a lagged basis. So essentially what we see is as the rates start to go up, we'll see a squeeze on the net interest margin of the equipment finance companies. There are some exceptions to this because you do have some equipment companies that fully hedge their exposures and therefore are immune to this squeeze. However, the other impact we do see in specifically in the ABS transactions as they're getting through the lag period and starting to pass along the price increases is that the composition of the credit enhancement does change for a time. And the mix is more of a mix of hard credit enhancement and less available soft credit enhancement in the form of excess spread. But then as the lag period expires and they're able to pass along the price increases, then the mix of credit enhancement does again start to normalize, and you'll have a portion of soft enhancement coupled with hard credit enhancement as well. And then in the opposite direction, again, there is a lag, as we've seen, that the equipment finance companies can hold pricing to some extent, but there is competition, and therefore we do see a slow pass through of some of those cost savings to the customers over time.
Okay, thank you. So then one last topic I wanted to kind of explore with you is private credit, and it's playing an increasingly important role in equipment finance. What are the key risks and benefits of this trend as a long-term source of capital?
Yeah, so let's start with the benefits, right? Private credit, we think, is more durable than the old GECC, CIT, Heller model, right? Where lenders and lessors raised short duration, market sensitive money. In times of stress, investors worried about a leasing company's ability to access funding, and credit crunch could ensue. Fast forward to today, where private credit with long-term locked up funding stands by opportunistically, ready to step in and provide needed liquidity in times of stress. They're not doing charity work, but their durability and the sheer size of that market and pool of dry powder, I would argue, makes private credit a better shock absorber in times of stress than the old short-funded market-sensitive lenders, right? The risks, well, funding can be expensive to the borrower or the lessee. There's also the risk that there is too much dry powder chasing too few good deals. If investors start to see problem credits arise in private credit, materially, if it starts to rise materially, I think you could run into that same credit crunch. But from our perspective, compared to the old model, this is really positive evolution, I think, in capital markets.
Great, thank you. So Joanne, I'm kind of curious to hear your view. What impact has the rise in private credit had in equipment ABS, and is it anticipated that it could, replace public equipment ABS given the current economic environment?
Sure. Yeah, we've definitely seen the impact of private credit in equipment ABS and equipment finance over the last couple of years. There have been many examples of startup large ticket equipment finance companies backed by private equity. And I wouldn't say that this is starting to become a replacement for equipment ABS. However, what we have seen is that in these more startup, shorter operating history situations, they are quickly moving to have a diversified funding strategy. To Van's point, we do consider a diversified funding strategy as a strength for any equipment ABS issuer. And what we have seen with these startups is that they will lean on the private equity to build a certain critical mass, but then they will move quickly to incorporate ABS issuance as part of an overall funding strategy. And this, relates back to what I was mentioning, that in those cases with shorter operating history, a lot of times the management teams are highly experienced from prior situations. And so we have seen examples where these startups, so to speak, that don't have quite as much operating history are able to access the ABS market quite quickly and at high rating levels, based on the experience of the management team and any relevant data that can be brought to bear to, that's applicable to the current situation.
Great, thank you. So changing gears once again, we've talked about a number of different things today, particularly about the economy and the impact on equipment ABS. I guess, Joanne, what metrics do you track to kind of impact the performance of equipment ABS transactions?
Sure. So in our surveillance process, we do track traditional ABS metrics such as delinquencies and losses, both on a gross and net basis, individually. But in tracking the equipment ABS market as a whole, we do have a very useful tool that gives you a great overview of the market as a whole in the form of our equipment lease and loan index. And this index includes performance of all currently outstanding equipment ABS transactions. And what we have on the slide here is the latest monthly installment of our index from April of 2025. And yeah, this is, quite useful, obviously, in getting a sense of any trends going on across the ABS market as a whole.
Okay, thank you. So Brian, maybe you can share with us, provide like an overview of the equipment loan and ABS index. And, if you can talk about things like the history of how long we've been publishing it, what it's based on, how it's put together, how often, all those things.
Yeah, sure. Happy to, Ken. So, we published we publish a monthly, this monthly credit index that tracks the entire universe of outstanding securitized equipment loan and lease collateral pools. When, as Joanne said, when we say the entire universe of securitized collateral pools, it's really any collateral pool backing a ABS that's rated, whether KBRA rated or not. We publish it on a monthly basis. Our first publication was in May 2021. So this last report that went out last week, was the 48th publication, a 4-year anniversary. The KBRA's equipment loan and lease index is a rolling index that KBRA calculates each month using monthly credit performance data from remittance reports. The index is weighted by each collateral pool's outstanding loan balance or a receivable balance. And we add deals after 6 months of seasoning so that there is some time to ramp up in terms of things like delinquencies and net losses. And then, as deals amortize, they become less significant in the index. So this month's particular index the overall index contained 120 securitized equipment loan and lease pools from 40 different ABS issuers that had an aggregate of close to $40 billion in receivable value. We then further break down our equipment index into both a small, medium ticket and a large ticket index. And the sub indices that, in a small medium ticket, there were 51 collateral pools worth close to 15 billion in outstanding. And in the large ticket, we had 69 collateral pools worth close to 25 billion. And as Joanne was alluding to, this is we right here we're only showing delinquencies and net losses, but we have a download file that also shows prepayment speeds, WAC and WALA, average WAC and WALA, and deal seasoning, average deal seasoning. So it's a good kind of broad look at the overall securitized equipment market from a portfolio perspective. Certainly, when you're looking at a deal by deal basis, it's much more important to look at the history of that particular issue. This just gives good broad trends within this universe. And we find a lot of our clients use it for their surveillance process as well as credit committees. So it's a really good tool that has been we gotten a lot of good feedback on.
Great, thank you. Joanne, maybe you can share with us kind of a historical overview of the performance trends that we see in the index.
Yeah, sure. So if we start with the overall combined index, which is on the top there, the first thing to note is consider that on an absolute basis, you can see throughout the life of the index that really delinquencies and losses on an absolute basis have been very low for equipment ABS and pretty consistent over time, generally speaking. Now, what you can see over the last couple of years is that there has been, again, still the delinquencies and losses remain on an absolute basis quite low, but you have seen a trend that they have been increasing to some extent over the past couple of years. Now, the causes of that you can see broken out in our sub indices. So looking at the small medium index on the bottom, the increases over the past couple of years for the small medium index really do represent normalization, as the index had historically quite low delinquency and losses during the COVID period, as performance was being assisted with all of the government stimulus that was going to businesses during this time period. And so what you see in the small medium index is that the more recent increases in both delinquencies and losses is returning to a more normalized level that is similar to the more pre-COVID levels. Now, the larger contributor to the increase overall in the last couple of years can be seen in the large ticket index. And one thing that I do want to explain is that we do label this our large ticket index, but I will say that large ticket equipment ABS does continue to be primarily a near zero loss asset type. But in the data that we use for our index, any transactions that are more heavily concentrated in transportation and trucking collateral are categorized as large ticket transactions. And so what you're seeing here in the large ticket sub-index with the increases in delinquencies and losses more recently, as you're seeing the impacts of those individual pools that are more concentrated in trucking and transportation. And you can see the impacts that have occurred over time. Basically, what happened is that during the COVID period, the values of trucks and transportation equipment were quite elevated. And you can see that this led to very low delinquencies. And when you look on a net loss basis, we even had some experience of even negative net losses as truck values were extremely high. Then what happened was, as the truck and transportation equipment values started to decline from their very high levels, we saw that while the underwriting was adjusted by the issuers that do play in this space, the timing was somewhat lagged, and therefore the pullback in conservatism in terms of the underwriting didn't keep up with the decline exactly with the decline in the equipment values. And so this is when you started to see some of the increase in the volatility on both the delinquency and the net loss side of things. And if you focus in on the annualized net loss trend, what you'll see also here is the increased lag period for recoveries on truck and transportation assets. And so this is why you see the phenomenon of sort of the stop and start, kind of a little bit more spiky trend of that net loss line there. Basically, what's going on is that as the volatility increased, the servicers did proactively repossess a large amount of truck and transportation inventory. However, the servicers were experienced and they didn't want to flood the market with the higher levels of repossessed inventory, but rather they wanted to opportunistically sell the inventory on a more lagged basis, so as to support getting the highest prices and recovery rates as possible. And so that's why you see it kind of fits and starts of the net loss profile, where the annualized net losses would increase as there were a high level of repossessions of trucks. And then as the servicers opportunistically put the equipment out to gain recoveries, then you see those recoveries offsetting and coming into the net loss calculation on a lagged basis and bringing it down. And then you see further cycles of increased repossessions, again causing perhaps a spike in a given month on the net loss basis, which then would be recovered later when some recoveries come in. Now, you can see in the index that, especially driven by, the truck collateral and the large ticket index, that there has been a trend upward. But what I will note is that, largely speaking, the equipment ABS universe, individual transactions generally are highly diversified along many different types of characteristics, including equipment types. So these impacts are really driven by just a handful of transactions that happen to be more concentrated in transportation assets. Generally speaking, there are transportation assets in many of the equipment ABS pools, but they generally are more highly diversified. And the other thing that I'll note is that as this stress has increased over time, even the issuers that historically were more specialized in truck and transportation lending and had pools that were more concentrated in these areas, they have diversified their managed pools, and they've as well diversified their ABS pools. And what we do see is, very few transactions coming out that are, highly concentrated in trucking and transportation. Really, overall, the pools are much more diversified into different equipment types and industries.
Hey,
Okay.
Joanne, I saw an earlier question from the audience about, the threshold for a large ticket. I can't remember it off the top of my head, but I will say that, our large ticket index is like 2/3 made up of John Deere, CNH, Mass Mutual, and Kubota. I can never pronounce it. While our small medium ticket is, primarily a Dell, Hewlett Packard, and Access. That's about 50% of the index, which is mostly office equipment, I think. But I don't know if if I don't think we had a hard and fast, kind of delineation there, but what is generally the difference between the two?
Yeah,
Okay.
we didn't have a hard and fast delineation. I would say that, sometimes there is more of a focus, around maybe the $200,000 area. But, what I will say is that, generally speaking, when you're talking about equipment ABS transactions, the deals that are more concentrated in trucking collateral do tend to be referred to more as small ticket deals, but in the data source that we use for this, those transactions were labeled within the large ticket index. And so the large ticket index really more is what you would typically think of as large ticket issuers like Stonebriar, MMAF, et cetera, which definitely tends to be more of a zero loss type asset. But again, what's driving really the volatility that's seen in that large ticket index is that the deals that are historically were more concentrated in those transportation assets are being categorized within that index. And that's why it's, it is a bit surprising, sometimes to see that a large ticket index where typically with those types of deals, they are very much near zero losses and delinquencies, having, some volatility. And it really is because these more transportation concentrated deals are categorized within this sub-index of large ticket.
Okay, thank you. I guess just one other question on the index and just really in general performance. More recently, has there been any signs of recent volatility or trends that KBRA is following?
Yeah, so we've only had this one installment of the monthly index since the tariff stress began. And we really didn't see yet any signs of tariff related stress in the one installment that we have presented here. This we do publish this monthly, so we'll continue to track, but really the trend in the most recent installment was a continuation of as mentioned, the trend we've seen over the past couple of years, which is somewhat of an increase in, delinquencies and losses, again, continuing to be quite low on an absolute basis, but is pretty much related to the deals that are more concentrated in the trucking and transportation assets.
Okay, thank you. So I think that's it for the formal presentation. We did have some questions come in both before and during the webinar here. It looks like we have some time, so I'll just go through what we can. So maybe the first question is for you, Joanne. The question is, has KBRA changed its equipment ABS methodology, and has KBRA incorporated additional considerations in today's environment of volatility?
Sure. So to the first part of the question, no, we have not changed our dedicated equipment methodology. But what I will say is that our methodology and our surveillance process does allow us to consider, current, the current stress environment. So one thing that we are doing in terms of both surveilling existing transactions as well as looking at new issue transactions is that we will take stock of, concentrations in any of the areas that I was mentioning before that could have tariff impacts. For example, if there are any concentrations and exposure to agricultural or construction equipment, or small businesses that may be an outsized obligor concentration in an otherwise granular pool that may have more exposure to import prices. What we may do in pools that have those types of characteristics and are more concentrated in those areas of potential stress, we may increase our loss assumptions to some extent, or also, cover, certain specific risks within a pool. But generally speaking, again, equipment ABS has been around for a very long time, and the methodologies have borne out that the stresses and the considerations and the multiples that have been taken into account, the ratings have successfully moved through other stressors, and the methodology is comprehensive enough to be able to take account for analytical judgment, to make some adjustments around areas that we see that may be coming up against, more volatility based on these tariff impacts.
Okay, thank you. Next question, Joanne, I think this one's for you as well. Has KBRA seen servicers making adjustments to ensure continued stable performance that KBRA can give credit to, like equipment finance companies' ability to and willingness to tighten underwriting during times of uncertainty like today, which is required to drive low loss variance and reduce volatility? And can I also talk about downside in asset performance? Sorry.
Sure, no problem. Yeah, I can take that. Yeah, so I would say that our ratings analysis definitely does investigate and give credit to the underwriting policies of the servicer. But our approach really is rooted in historical data. So we are not going to be able to give credit to a change in underwriting that is more recent unless we do have some type of historical data that would be able to justify that this would indeed, has historically led to lower loss levels. So, we do give credit to underwriting, but again, the approach is based in historical data. Now, the one thing that I will say is that there have been adjustments made, especially among some of the issuers where they had historically been more concentrated in transportation assets, where they've been diversifying into other asset types. And in those situations, if we do have cohort data rather than total data that's available. So for example, if we have historical data that's broken down by specific equipment types or specific risk tiers, and that data can be presented and is fulsome, then what we can do is come down, and give some credit to a diversification strategy if the pool mix is improving and moving, away from potentially the trucking or transportation assets that have had, more volatile performance. So I would say the short answer to the question is that yes, I mean, we do give credit to underwriting, but again, has to be backed up with some degree of historical performance showing the outcomes of that underwriting policy.
Okay, thank you. So kind of combining a couple questions here, Brian, for you, I think, kind of putting together all kind of the same bucket. So is this a good time for first-time issuers to be approaching the market? If you can speak to pricing that we've seen recently, if the pricing has been holding up for repeat issuers, should this be a trend for new issuers?
Yeah, I mean, it's yeah, I think at the end of the day, we've gone through this rising rate environment. The toughest time, as Joanne was talking about before, is when interest rates are rising, but there's that lag of passing the cost on to issuers. So you have kind of lower lease rate collateral, higher yielding debt, asset liability mismatch. But since we're beyond that, and possibly we'll start seeing interest rate cuts later this year. I think it's certainly favorable from that asset liability perspective. Like I was saying before, spreads are wider than they were pre-Liberation Day. But you got to remember, like to start the year, the first quarter, we were seeing spreads at, I think the corporate market was at like the 1 percentile tightest it's ever been. And I think ABS wasn't that far off, maybe, the 5 to 10% percentile. So, we are at so even with some of the widening, which has kind of come in at this point, we are at extremely tight credit spread levels currently. There's a lot of demand there from investors, given, the higher yieldy assets now, as well as just kind of a paradigm shift from insurance companies needing to match their annuity liabilities, with longer dated assets. We're seeing most deals are very oversubscribed, not just in equipment, really across, most debt products. So, I think this is a good time, to come to market. First time issuers are always going to give up a spread concession versus, the programmatic issuers like John Deere, CNH, Great America Leasing. But yeah, certainly I think it's a favorable form of funding compared to the bank market, leverage loan. Assuming first time issuers probably aren't going to have a high investment grade rating. It's a great way to kind of get secured debt financing at low rates. So yeah, very bullish on our markets right now.
Okay, thank you. Maybe just one more question, Van. I'll kind of end it on you. There's a couple questions I think that towards you. Are there specific data points that are most impactful that you're tracking to update your views on the economic outlook, and then how can you keep up on KBRA's view over time in the changing environment?
Sure. So in terms of the things worth watching, number one, right, the labor market, right, holds the keys to consumer spending, reflects business vitality. You've got to ask yourself, how do things change if we do get a negative non-farm payrolls print at some point over the balance of the year? So we watch closely the trends in the labor market. Next up, inflation data. We've been reminded that investors, consumers, most businesses, and clearly the Fed hate inflation, right? So keeping inflation under control. We've got some inflationary pressure coming back. It's worth watching closely as the tariff impact starts to flow in over the next 3 to 6 months. The third thing we watch probably is corporate earnings growth, right? I'd argue that every single asset class in credit is underpinned by the health of the corporate sector, right? So corporate earnings growth, which is coming down. Consensus for the S&P 500 is now back to single-digit growth. We were at probably 15% at the turn of the year. So it's clearly coming down, but still staying positive. But we watch it closely quarter by quarter and paying close attention to guidance in terms so we can get a sense as to what's ahead. And then the final thing is just obviously market data on risk assets. Brian referenced just how tight spreads are. The broader theme really is that fixed income product has become in greater demand. So if you look at stocks trading at still really, really frothy sort of levels with the uncertainty that's out in front of us, high quality, corporate and asset-backed credit fits nicely into a more defensively oriented portfolio. So again, we watch closely to see obviously trends of risk premia, both in the equity market and the credit markets. Both of those are well behaved, but again, subject to change. So we'll watch closely what's going on in markets. The last thing is I'll plug my podcast, which I think is the third QR code there on the right. We are in the midst, or we will release version 200 this Friday. So we do it every Friday It's 10 to 12 minutes of the most important things that we think are driving credit markets that week, or what you should pay attention to. You can find it via the QR code or certainly on our website, but love to have you as a listener. Yeah, so that's what I'm paying attention to.
Great, thank you.